Good morning everyone. My name is Sandeep Guhe, student of SAS Institute second year. Today I am giving presentation on security analysis and portfolio management. In that subject, my topic name is bond valuation. Introduction. Bonds are the long-term fixed income securities. Debentures are also long-term fixed income securities. Both of the are debt securities. There are two major categories of the bonds are government bonds and corporate bonds. There are two main features of bonds such as the callability and the convertibility. Bonds return coupon rate. It is a nominal rate of the interest fixed and printed on the bond certificate. It is calculated on the face value of the bond. It is the rate of the which interest is payable by the issuing company to the bondholder. Current yield. The current market price of the bond is a secondary market may differ from the face value. The current yield related the annual interest receivable on the bond to current market price. It can be expressed as follow. You can see in that slide. Bond return spot interest rate. Zero coupon bond is a special type of bond which does not pay annual interest. The interest on this bond is the form of discounted issued of the bond. This types of bond is also called as a pure discounted bond or a deep discounted bond. Yield to maturity YTM. This is the most widely used measure of return on bonds. It may be defined as the compounded rate of the return an investor is expected to receive from a bond purchase at the current price and held to maturity. It is really the internal rate of return earned from holding a bond till maturity. YTM depend upon the cash outflow for the purchasing the bond, that is the cost or current market price of the bond as well as the cash inflow from the bond. You can see in that slide the relation between the cash outflow, the cash inflow and the YTM of a bond can be expressed as MP is equal to CT upon 1 plus YTM TV upon 1 plus YTM and square. Bond return. MP means current price of the bond, CT means cash inflow from the bond throughout the holding period, TV is equal to terminal cash inflow received at the end of the bonding periods. Bond purchasing theorem. The relation between the bond price and the changes in the market interest rate have been studied by Bertonchi Mekil in the form of the 5 general principles. These are following. You can see. Interest rate risk. The risk that investment's value will change due to the change in the absolute level of the interest rate. Such changes usually affect security annually and can be reduced by the delivering the hedging. Interest rate affected the value of the bond more directly than stocks, and it is a major risk to bother holder as a risk. Interest rate risk bond price fall and vice versa. Bond duration. Duration is the weighted average measure of the bond life. The various types period in which the bond generated cash flow are the weighted according to the relative size of the present value of the flow. The formula is using, you can see, where CT is equal to annual cash flow including interest and repayment of the principal. N is equal to holding period. K is equal to discount rate which is the market interest rate. T is the time period of each cash flow.